Alibaba stock is the topic of today's presentation, and this slide says Alibaba stock warning. If you're somebody that's holding shares of Alibaba, this is a presentation that you're going to want to watch all the way through. We're going to start by describing the bull thesis, which should be rather apparent. So the DEI charlatans love to describe populations using these broad categories and checkboxes such as Asians. And when we talk about Asians, that's really unfair to group 60% of the world's population into a single category when Asia is in fact a very rich place. In the lower left here, you see a table where we've broken down what a room full of 100 people would look like if it truly represented the world's population. So 18 individuals would be from China, 18 from India, so on and so forth. China is the world's most populated country. It will soon be overtaken by India, but for now it's a country where there's a lot of opportunity for any number of reasons. So the idea is that Alibaba is a Chinese Amazon. So we've seen the Amazon success story over the years, and Alibaba is going to replicate that, or is replicating that, in China. Here we've put on the left the size of both these companies, so you compare the two, and on the right you can see their revenue growth over time. Now on the lower left there you see several numbers, 2 and 2.3. Those represent our simple valuation ratio, where we take market cap, divide that out by annualized revenues. And in our 460 tech stock catalog, the average for the companies we've calculated that for would be around 6. So Amazon's quite quote-unquote cheap, and we'll talk about why that might be. But first, let's look at the two business models. So on the top there, that table shows Alibaba for the last 3 years and the categories, revenue segments they use to describe their business. At the top there, you see customer management services. That's pay for performance marketing, in-feed marketing, commissions, things like that. It's the slowest growing segment, but it happens to represent 44% of their business. And then you can go down the list here. On the right of that table, we've put the 3-year compound annual growth rate, and you can see that as a whole, Baba's growing fairly fast. Now below that, this is very interesting. It shows Amazon's breakdown for the last several years, and the drop that you see there in international revenues, 15 billion of that would be described by foreign currency fluctuations, though even if you add that back in, they're not growing international very fast. But what's really interesting here is to the right of that table, you see net income. How amazing is it that their sales, so the majority of their business, they're somewhere around 85% of their business is around selling products. But neither of those categories were profitable in 2022. All their profits came from just 15% of sales, which were relating to their cloud services. So Amazon, one almost could argue, should be acquired by a private equity firm who would then unlock that value and raise the valuation ratio to where it should be. So the parts separated would be worth more than the parts combined. But be that as it may, let's get back to talking about Baba. Now, there's an individual out there, and we looked around for short reports or people that are really scrutinizing Baba heavily, and there's one individual that stands out. He's anonymous, so it's not really worth describing who this is. On Twitter, you can find him under the handle Deep Throat IPO. And I think some of the things that he raises are certainly worth taking a look at if you're heavily invested in Alibaba. So, for example, he questions how, since their IPO in 2014, they were able to grow what he calls questionable assets from $7 billion to $168 billion. So what we did here on the right, we simply took their assets from the latest 20F, that's the 10K equivalent for foreign firms, and then we sort of colored their things that we might want to take a little closer look at, and it's very, very difficult to start going down that rabbit hole. We've described their $160 billion worth of stuff that's quite difficult to figure out once you start going down those rabbit holes. Now, some easier things to ask, some questions that you might consider would be, look here, for example, on the annual active consumers metric that Baba provides. They talk about having 953 million consumers in China. Well, that happens to be the entire adult population of China, people aged 15 to 64. So every single person in China is using Alibaba. Maybe that's the case. It certainly well could be, but where does that leave room for more growth? And then they talk about 285 million consumers overseas, and certainly they can start to grow their business overseas as well. But what's also interesting to look at would be the amount of money that they say is going through their platform. So again, going back to the GMV metric, somewhere around 25% of China's consumption is going through Alibaba's platform. And you can see for Singles Day, this is a holiday in China that's similar to Valentine's Day, they had somewhere around $84 billion go through their platform, roughly several months worth of Walmart sales. And the numbers are spectacular. And again, you would expect that from a firm that's selling into the world's biggest population. Sure, there would be some very surprising numbers coming out, but we were holding Alibaba for quite a while. It was our biggest position. And where we started to have our concerns was when Jack Ma appeared to be forced out. Now, if you're not familiar with who this individual is, you certainly should be. He's the epitome of a PhD, and we talk about PhDs, that stands for poor, hungry, and determined. When he got out of college, and he wasn't very good academically, which in China is sort of the kiss of death, and he applied to be a cop, and 4 of the 5 applicants were hired. He wasn't. The famous story, went to get a job at KFC. Again, somebody who's not afraid to work in any job, a hustler. 24 people applied, 23 were hired. He wasn't. He lost out to a waiter role at a 4-star restaurant to his cousin. He was rejected by VCs in America for Alibaba, turned down by Harvard 10 times. This man has tenacity, and he makes things happen. And he was one of the main reasons why we invested in Alibaba. Now, in late 2020, we decided to evaluate our holdings while we were putting together our current 38 tech stock portfolio, and Baba being our biggest position, we had to make a decision. So we first wrote about how to invest in the Amazon of China, and then talked about all the main bullish points for Amazon. But where we became quite concerned is when we started digging into the VI structure for Alibaba, and we've described that in our piece here, a big bear thesis for Alibaba stock. And we became so concerned with what we saw that we exited our position, and the black cross that you see here, that's around right when we sold our position, and we did so over a period of time in the same way you might use dollar cost averaging to buy. We sell over a period of time to reduce market timing risk, and we exited our entire position. And it happened to be a good time to exit Alibaba. Honestly, it was a serendipity more than anything. But what we found out was rather shocking, that Alibaba trades under what's called a variable interest entity, or VI for short. And what this does is it bypasses Chinese laws that limit foreign direct investments. This structure, plain and simple, does not give the holder legal right to shares of the underlying company. It's that simple. Numerous warnings have been issued by all kinds of institutions in the United States, making sure that investors understand the risks that they're taking. And when you start to try and describe Alibaba based on their convoluted legal structures, for example, here's a list of all the major subsidiaries of the company, and we've highlighted one there. This is Alibaba.com International Holding Limited in the Cayman Islands, and look at this mess. That's the structure underneath one of their subsidiaries, where you can see there's equity interest, contractual arrangements, they're using options. It's an absolute mess that it's hard to imagine any accountant being able to get through this entire structure and sign off on their financials, but somehow that's happening. And it's not just for Alibaba. 545 mainland companies last time we checked, most of which are technology firms, use VISE structures so that United States investors, let's say foreign investors, can buy shares in these companies. And you may have seen news rather recently talking about how investors are happy because China is going to provide some more clarity on these VISE structures, essentially saying, oh, it's okay. Well, we'd hope the Chinese government says they're okay, but what you need to pay attention to is what the legal experts have to say, and this individual here is certainly qualified to have an opinion about this. He's a teacher at the University of Cambridge, formerly a Chinese judge in Beijing. He was an in-house lawyer at Alibaba, and he describes the problem and succinctly says Chinese authorities remain reluctant to clarify the legality of the VISE structure. And this here says it all. So this blog entry you may want to take a look at. You can just Google it. And he talks about the multifaceted legal risks to foreign investors who choose to dabble in VISE structures. In the event that they're invalidated, investors could lack effective remedies at both local and international levels. And his claim is that on this other paper, when Enron met Alibaba, The Rise of VISE in China, he claims that VISE structures are discounted by around 30% to account for these risks. So some of you may say, well, it's certainly, I'm happy to take that risk. Well, fair enough. But what you need to also be concerned about, or let's say a way that you might mitigate that risk would be to look at what Chinese companies are doing in response to activities in the United States. So ADRs, what's called American Depository Receipts, are securities that represent shares of non-U.S. companies traded on U.S. exchanges. This is rather common. But in 2020, there was this act passed, the Holding Foreign Companies Accountable Act, which allows the SEC to ban companies from trading and even be delisted from U.S. exchanges if American regulators aren't able to review company audits for 3 consecutive years. That's not asking a whole lot. So the earliest a company might be delisted would be in 2024. Well, the disputes with China over this act have caused U.S.-listed Chinese companies to increasingly become dual-listed in Hong Kong. And in 2019, perhaps not in response to this act, but shortly before it, perhaps anticipating this act, Alibaba listed on the Hong Kong Stock Exchange as a secondary listing. And here you can see an article from summer of last year that says Alibaba gets Hong Kong's approval for a primary stock listing. So they're now moving that from secondary to primary. And one of the things that allows for is that Chinese mainland investors can now start to get access to shares in Alibaba. What's interesting to see is when you look at institutional holdings for BABA, the ADR in the United States, and you see here is an example of BlackRock's institutional ownership completely taking a dump in early 2021. Well, if you know anything about how institutional investing works, there's active investing and passive investing. BlackRock is one of the world's largest passive investors, along with Vanguard, so they have to get the exposure to these shares regardless. So they're not actively taking a bet necessarily on BABA. What they're doing is trying to simply get that exposure so that their ETFs can track the performance of these shares. What they may have done here is simply moved their exposure from the US ADR to the Hong Kong exchange. And when you look at BABA on the Hong Kong exchange, they listed that secondary listing and saw an increase in trading volume as a result. And they talk about how moving to a primary listing, it says, will allow us to broaden our investor base and facilitate incremental liquidity and expand access to China and other Asia-based investors in anticipation of potentially not being listed in the United States. You may ask, well, what happens when shares cease to list in the United States? Well, maybe that goes back to the risks described about VI structures being invalidated and investors not having recourse in the domestic or international domain. So this is a very valid concern, this VI structure problem, that you can certainly mitigate by purchasing shares on the Hong Kong Exchange using an international broker such as Interactive Brokers. That's one way that you might get around that. But there's problems that go beyond that. And we did a presentation, and I'll link to that in the description of this video, and a research piece on the dangers of Chinese stocks. And the biggest problem perhaps would be that Chinese businesses are reliant on the Chinese Communist Party for their success, and it's estimated that up to 30% of business profits come from the CCP. They're the gatekeeper that determines which businesses succeed and which fail, and public perception of the CCP isn't so good. There was this survey, famous survey done, that shows prostitutes in China are actually more trustworthy than government officials. So ladies of the night were in third place behind farmers and religious workers, soldiers in fourth place. So the country itself doesn't have a very high perception of the leaders because of all the corruption. And what you need to understand about the Chinese culture is that they love to take risks and skirt the rules. It's hero or zero in that country. And to get a good picture of that, look no further than the shadow banking system. I did a master's in finance at one of the top universities in Hong Kong, and my thesis was on Chinese shadow banking, and I had to describe this absolute mess, and I certainly couldn't do that again. It was very, very difficult to understand, and I more or less parroted what other experts had to say about it, in that it's an absolute mess. And this is the sort of risk. And when we talk about shadow banking, this is all illegal stuff. It flies under the radar. How does that happen? Well, when you have a very corrupt government that sort of turns an eye away from it, then things like this can happen. So the question we might ask would be, would we invest in Baba again? So the price has certainly come down quite a bit, and we could sidestep the VI structure problem in the United States by buying shares on the Hong Kong Stock Exchange. So if things go pear-shaped, even though VI structures are used on the Hong Kong Stock Exchange, it seems like that's a lot safer place to be. I'm a Hong Kong citizen. That certainly helps, though they may also take into account my U.S. citizenship. Maybe the bigger question to ask here is, would we invest in any Chinese company knowing what we know about the culture and the country and the leaders that create a very corrupt environment to do business? Well, we might invest in H shares. That's the safest way to invest in China, but the problem there is that all the tech firms aren't listed as H shares. I'm not going to go into the details of how that works, but on the right here you can see the largest H shares in China, one of those being BYD, and that's actually on our list to revisit the Tesla of China. But let's wrap this up today. So to conclude, only invest in Alibaba shares using the Hong Kong listing via Interactive Brokers or another reputable international broker. By the way, this picture here is in a gambling hall in Macau, where all the Chinese love to play baccarat. You'll be able to tell what game that is because you'll see them take their cards and bend them, render them useless. They're quite superstitious. So if you go and play blackjack in Macau, what might happen is that you might have some very rich Chinese come up behind you and start putting money on your hand. They're allowed to do that over your shoulder, and it can all be very nerve-wracking when you're having to hit on a card that they may not necessarily understand the math behind that call. But it's a very interesting place, so we'll quickly give you a picture into how much the Chinese love to take risks and how superstitious they are. So the thing that you need to be most aware of is that these embedded cultural risks and the fact that corruption doesn't stop. It only increases. So when you're 12 people that are corrupt managing a firm and a 13th person finds out, you simply split things 13 ways. That's how it works. So it keeps getting worse and worse. And There's high levels of company-specific risk, which means that companies can simply implode. Think Luckin Coffee as an example, the Starbucks of China. So you're always better off spreading your bets. Now, I've put up another video here on the problem, the dangers of investing in Chinese stocks. But before you watch that, please click the Nanalyze logo here on the right. Subscribe to our channel. Support us. Thanks so much for taking the time to watch this today.